Hello again, everybody. I'm Jeff Dorman, CIO of ARCA, back for another edition of That's Our Two Satoshis Live. And this week, I am joined by one of my favorite people in crypto, Noelle Acheson. How are you today?
Really good to be here with you, Jeff. I'm doing well. How are you doing? I'm loving your background.
I'm great. Yeah, it's sunny and nice in Los Angeles for the first time in about 3 months. So things are good. Crypto markets are up. Weather is good. And I get to have a conversation with, again, one of my favorite people who I haven't seen you in a long time. I hope you're doing great.
I'm doing really well, thank you. Right, it has been way too long, and the fact that we are on opposite ends of the earth actually shouldn't matter so much these days.
It's true. In fact, I can't even remember when I've last time I see people in person versus just on Zoom because it is such an interconnected world these days. For those not familiar, though, Noelle is the author of one of my favorite blogs, the Crypto is Macro Now blog, which I hope everybody at the end of this jumps to subscribe to. And the format of this is always, we've been writing about the digital asset markets here at ARCA for about 5 years now. We have a blog on our website, ar.ca/blog called That's Our Two Satoshis, where we talk about markets. And Noelle is probably the perfect person to talk about this week about what is going on in the macro world that is driving digital assets. But before we get started, as always, quick disclaimer, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. So, Noelle, you and I have been talking about macro for a long time, and I think sometimes on opposite ends. I think obviously the title of your new blog, Crypto is Macro Now, talks about all the different reasons why the macroeconomic picture is driving crypto. I've been back and forth. I've been toggling. Sometimes I think macro is the most important driver, and sometimes even the only driver. And other times I actually think it's been taking more of a backseat to idiosyncratic news. But I think it's very certain that over at least the last 3 weeks or so, macro is back driving the bus. And I think it is 100% related to what is happening with the banking crisis, starting here in the U.S. And then obviously trickling into Europe with Credit Suisse and potentially now Deutsche Bank. Um, in my opinion, I'm seeing a pretty classic macro recession playbook right now, which is front end rates down sharply, long rates only down slightly. So basically a bull steepener in rates. You're seeing gold and Bitcoin ripping. Gold was even approaching an all-time high. Crude oil was getting hit hard. Small caps and growth stocks were underperforming large caps, and value and defensives were leading cyclicals. And somewhat maybe paradoxically, technology actually getting a little bit of support just because of falling rates. Where does crypto fall in all this, right? Is it following gold? Is it following equities? Is it following the anti-banks? It sort of seems like every day it's following something new. What are you seeing?
Every day it's following something new, and as you mentioned, the narratives, macro in, macro out, they are becoming increasingly complex and intertwined. And you and I have been discussing over the years, as you say, how influential macro is. We haven't always agreed on this, but one thing that I am becoming increasingly aware of is that macro in itself is no longer the only driver, especially now. You've mentioned the banking problems, which are giving a big tailwind to the insurance narrative. I like to call it the insurance narrative rather than the safe haven narrative, because that's, in big air quotes there. The insurance narrative can be being an alternative to the traditional banking system. This is a narrative that definitely fell out of favor when everyone was just in it for the big returns, and it was the institutions piling in. We remember those rather uncomfortably dizzying days. But now it is, again, institutions seem to be back because originally the macro piece, the Fed pivot, the will he, won't he, and now increasingly the insurance. But it's those narratives. It's the macro, and then of course the crypto specific insurance narrative. But we also got some market structure stuff coming in. I was looking this morning at some of the liquidity data that Kaiko compiles, and liquidity and even the Bitcoin market, one of the most liquid markets in crypto, is remarkably thin, much
Yeah.
thinner than it has been in previous stages of this cycle and other cycles as well. And that obviously gives some structural boost to sharp moves in the prices. So there's just a lot going on. And we can't even say anymore, Jeff, that they're distinct, because the crypto insurance narratives depends on the macro narrative, which
It's true.
depends on the whole economic cycle. One
Yeah,
thing you mentioned about all the different metrics that are looking wobbly, I keep an eye on the dollar. The dollar has traditionally been very inversely correlated to Bitcoin, or should I say the other way around? And there's a big air quotes around the word term correlated there as well. But here we have, again, traditional relationship, dollar coming down, Bitcoin going up. But what's different here is that why is the dollar coming down when things are so uncertain? Bitcoin is more of a safe haven these days than the dollar. That is a definite narrative pivot.
Yeah, for sure. And I think obviously the dollar also inversely related to interest rates. As interest rates come down and Treasury bonds go up, the dollar goes down. So I think this sudden change, certainly here in the U.S., with thinking the Fed is going to pivot, really it was probably one of the biggest 10-day changes we ever saw. I mean, don't forget a few weeks ago, the
True.
market was almost fully pricing in a 50 basis point hike with subsequent 25 basis point hikes. And then by the time the first and second and third and fourth bank failed, we were now pricing in a full 100 basis points of rate cuts towards the end of the year. So a pretty big shift in expectations there. I think for me, and again, this is very Bitcoin specific, not necessarily the rest of the market, but I think, Bitcoin has always been very amorphous, right? It has a lot of different shapes and colors, and you never really know which of the narratives is going to catch on and which one is real versus more just sort of hype. But I think every once in a while you do see where the flow of funds really does follow the narrative, not just the Twitter chat, and this was one of them. I mean, if you look at the graph of KRE, which is the U.S. regional banking ETF, versus Bitcoin, it has been completely 100% inversely correlated, basically since March 9th, since the first hiccup at Silvergate, which then extended to Silicon Valley Bank and Signature, and then eventually Credit Suisse, and now First Republic and others. I think that was really telling. And the other thing too that I think is really important is that there's really been a flow of funds that you can see as you see regional banks especially losing depositors, right? You can see all these depositors that have left, obviously the ones that have actually gone under, like Silicon Valley Bank and Signature and Silvergate, but even some others. It's about 25 to 30 billion where that money had to go somewhere, right? Obviously some of it went to some of the bigger banks, right? The too big to fail banks, but some of it did find its way into Bitcoin and other digital assets. And then you look at stablecoins as well, right? About a reduction of 15 billion in stablecoins, mostly BUSD, but also USDC, because again, they have to have U.S. banking relationships in order to house the reserves. All that money, that's about $45 billion that left regional banks that were servicing crypto and left banks that were servicing stablecoins. Even a small fraction of that makes its way into the digital asset market, and that's a huge move in price. And when you couple that with the fact that because it's being harder to bank, it also makes it harder to be a market maker, right? When you don't have easy flow of funds. So you have lower liquidity while you also have money entering the system. And that's why you're seeing such a big move in prices. And I think, again, sometimes we laugh at the Bitcoin narratives because you can't really prove it and it's more of a crypto Twitter thing. But, there are instances, 4 or 5 really in the last 5 years where the flow of funds absolutely back up the narrative shift as well.
Yeah, you're definitely seeing that. And we also have a different type of narrative, which we haven't mentioned yet, which has got nothing to do with any of the above. And it's just the momentum narrative. People are wondering, where's the money going? What will be the best move? Where will I get the best returns? And they may not care at all about crypto, but that's where the money is. So that's where they pile in, which exaggerates the move, which brings in more momentum chasers, etc. We've been in markets like that before, you and I. They're uncomfortable, but they're certainly dramatic.
For sure. And I also think the other thing too, and I've been full time in digital assets now for 5 years, and obviously, personally before that. One of the things that always struck me was, I was there in 2008 on Wall Street watching kind of the loss of confidence in banks and the government. And that sparked things like Occupy Wall Street, which was, not really super effective, but it was certainly a powerful message, even though it didn't really have a whole lot of effect on the future of banking or governments or anything like that. But the message was, we're tired of this and we've lost faith in the governments and banking. And you're seeing a little bit of that again now, and don't forget, obviously 2008 was when, the Bitcoin white paper came out, and that was sort of the genesis of Bitcoin. But really, Bitcoin wasn't a suitable alternative at that point. Whereas you flash forward now to 2023, and you're seeing that same kind of loss of confidence. And what I mean by that is, the Fed has basically lost a lot of credibility, right? And I would say other central banks as well, right? The Fed funds rate is now 125 basis points higher than the 2-year. 3 weeks ago, it was the opposite. The 2-year rate was higher than Fed funds rate. So that's basically the market telling you, we don't believe you, the Fed. We don't believe your path because we are taking things into our own hands and jamming rates 100 basis points lower, even though you're telling us the opposite. So you've got the Fed that's lost credibility. Second, you've got the Fed put back in play, right? If they spent a year with basically quantitative tightening, reducing the balance sheet, and in 2 weeks they basically, 60% of what they did over a year was unwound in just 2 weeks because of this banking crisis. So you've got the Fed losing credibility, the Treasury also losing credibility. Janet Yellen. Obviously the FDIC, the Fed, and the Treasury all came out at the same time to backstop the regional banks after the Silicon Valley Bank problem. But then Janet Yellen has been flip-flopping on whether we're going to offer explicit support or not beyond FDIC protection. And she's gone back and forth on TV, multiple times saying, yeah, we're going to backstop it, or actually, no, I can't decide, or what are we going to do? So now you have a little bit of a loss of faith there. Further, you have Credit Suisse, basically a forced shotgun marriage to UBS, where shareholders were left out, and even their COCO bondholders were left out without any shareholder vote. So again, now you have an accelerating question of, well, is my government going to take over my assets and give me a zero? And when you put all those things together, it's not surprising that crypto app downloads jumped 15% last week, while those of banking apps fell around 5%. And that's a meaningful vote of confidence in crypto as a protection of your assets compared to banks and government, where you start to question that. And I think that's the kind of thing where we don't know exactly how this is going to play out, but it's very similar vibe to 2008, only for the first time there's an actual solution.
Absolutely. And the cultural aspect, I mean, the fact that we have crypto app downloads increasing, bank app downloads decreasing, that's actually a cultural statement that has been largely overlooked. 2008 was a long time ago. Let's face it, it may feel like it was yesterday, but it was actually a long time ago. And the culture of the investing public has changed a lot since then. 2020, let's cast our minds back to there. It wasn't so long ago. GameStop. It was very much the middle finger to the establishment. It was very much the YOLO. It was very much, I'm investing for me. The young people of today, and I've got kids who are late teens and early 20s, and they are bleak about their future. They don't trust the government. They don't trust the central banks. They don't even trust a pension fund, because they don't know it's going to be there when they need it. So they really are in part of this YOLO investing ethos, the YOLO investing culture that we saw evidence of in 2020. And I don't think it's gone away. I mean, the fact that Dogecoin is still doing as well as it is evidence of that. The fact that crypto is seen by many as not just a statement against the current establishment, a relatively fair one, let's be honest, but also a cultural belonging that young people, especially today, are looking for. I think that is going to be another narrative to add to the soup that we've been talking about so far going forward.
And I think it's really important, because this is obviously a very different banking crisis than 2008. In 2008, the assets the banks owned were toxic, and they were worth zero, right? These CMBS, these regional mortgages, some of the insurance companies selling CDS of high yield bankrupt companies. There was nothing you could do to fix the assets. You had to just inject liquidity. This is a different banking crisis, where the assets themselves are largely U.S. Treasuries and AAA securities that are just underwater temporarily, but not really, going to lose value ultimately. So it's not the same kind of a banking crisis, but it is generating that same cultural response of, I just don't want to do this. I don't believe in my government. I don't believe in the banking system. I don't believe in the financial elite and the 1%. And I want to find something else. And whether it's spiritual or cultural or financial, there is a real reason to support some of these digital asset projects and protocols and narratives. And I just don't think you can put the genie back in the bottle once you have that. And I think probably most interesting, and you and I were talking before we jumped on here, all this is happening while you have just a complete affront against the digital asset industry. You have the White House with 37 pages talking about how dangerous digital assets are. You have the SEC continuously on a warpath. And now, just this week, you had the CFTC file charges against Binance and against CZ, which I haven't had a chance to digest yet. But it makes you wonder, like, where would this industry be if you weren't also just under siege from regulators around the world constantly, while the voting public is basically voicing their opinion in favor of digital assets, while regulators are basically telling you, get out of here.
And it highlights how political this is becoming as well. Yes, we are getting a lot of hostility from the White House, and it just blows my mind that the executive order, which was pretty supportive, was just over a year ago, literally just over a year ago, it was released. And we were all so surprised back then at the support coming from the executive of the highest, the largest financial market in the world. And fast forward to today, a lot of regulatory hostility, I think I'll use that word, hostility against the industry. But we tend to forget this is bad now. However, this administration doesn't have that much longer to run. This is becoming increasingly political. We saw in the midterms some Bitcoiners running for office, and that's certainly not the last time we're going to see that. And eventually some of them will win. Some of them already are in office, actually. We do have some pockets of support in Washington, D.C. It's astonishing that this is going to become increasingly political at the same time as it is becoming more global. We are seeing other jurisdictions such as Europe, for sure, but also Hong Kong, and by proxy China, open up a bit towards towards the potential that crypto assets have to revolutionize finance. And this is happening while the US is trying to push these businesses offshore. It eventually is going to become a geopolitical tool.
And that's one of the things I wanted to ask you, because you are over in Europe. I've always said that the U.S. isn't as important as the U.S. thinks it is, right? We hear, especially even when we live here in the U.S., we're very U.S. centric and we talk about it all the time. But this is a global industry with perfect substitutes everywhere, very low barriers to entry. No matter what you kill in the U.S., there is a perfect complement substitute somewhere else in the world that's doing the exact same thing that money and investors and developers will flock to. So when we're talking here in the US about just this constant kind of negative headlines and regime, how much of that is making its way over to you, or is in Europe, is it feel like the US is just a sideshow relative to the growth in digital assets?
I don't, from what I gather from talking to people in the European Union in office who've been working on this, they don't really pay a lot of attention to what the US is doing on this. The European markets are very, very different, not just structurally, but also culturally to the US market. And obviously the US market is the largest financial market in the world, but the European Union doesn't care too much about that. It's got its framework, it's slow, it's a totally different legal structure as well, very top down, whereas the US tends to be more bottom up. I mean, just imagine that we were told, the US was told, you just have to now come up with a cross-body comprehensive framework top down. The US wouldn't be able to do it, but that's how Europe has been run for the past few decades. So it's a lot easier for it. The more interesting places I'll say to watch are going to be Hong Kong, where it is slightly more, they are slightly more tuned to what the US financial markets are doing. And I would say also places like India and of course, more sensitively, Russia.
Yeah, for sure. Well, it'll certainly be interesting, to see where we go from here from an economic perspective, because, again, this has been such a fast shift in expectations over the last few weeks, and to see, digital assets, the response that we've seen so far this year to both the hostility from the regulators as well as just this, banking crisis and macro shift. It's hard to process. I mean, again, 2-3 weeks ago, we were basically on the inflation above all else, and that's all that matters. And now we're on, how do we save the the banks and depositors and basically the economy, right, as the recession trade builds up. So it'll be interesting to see. One of our analysts here at ARCA has been, dead set that, anytime you see these kind of recessionary conditions, it has been negative historically for digital assets as well. But we've never actually really seen a recession during the time that digital assets have been here, right? We've seen heading towards a recession like 2020, but that was quickly staved off by stimulus. Same thing again in 2018. The Fed very quickly reversed, and so did other central banks around the world. So we've seen these like preludes to recession that have been negative for digital assets, but we've never actually seen a recession. If we do, I'm very curious what your thoughts are on, do digital assets trade more like tech stocks, or do they trade more like, a safety asset that of something that you can potentially protect some purchasing power, and even maybe protect, the physical assets through the idea of these being bearer assets?
I would say definitely the former, definitely the tech stack, simply for the simple reason that is what drives the volume. The price is always set by the last trade, and the chances are the last trade is going to be from a trader who sees it as a speculative asset, a tech asset, a risk asset, whatever you will. But meanwhile, there's the long-term store of value accumulation going on. And yes, we could see some big buyers come in, especially given the low liquidity, who could move the price up. But most of the price moves are set by the shorter term points of view. You can see this on chain, just something like 70% of any daily move is of Bitcoin that last move 24 hours ago. So you can have both. I mean, you do have both sets of activity going on. We saw even during most of that the 2022 dreadful year, but there was steady accumulation going on. More than 70% of Bitcoin hasn't moved in over a year, 50% hasn't moved in over 2 years, and they could have sold any time over the past year practically at a profit. But what I want to ask you, Jeff, if I can turn the tables here a bit, is what you think this will do for DeFi. And I'm asking for two reasons. One, we have seen recently the mother of all stress tests. We've actually seen this several times over the past few months. The mother of all stress tests in DeFi held up just fine. Even that rather worrying weekend where USDC looked like it was depegging, it recovered and the DeFi platforms worked as they were supposed to work. But also, you mentioned earlier how we know that there are outflows of deposits from banks. And how do we know this? We know this because we get weekly reports. We get weekly reports of arguably among the most important flows in the economy at the moment, whereas in DeFi, it's real time, the kind of flows. Do you see in the people that you talk to a pivot of interest towards how DeFi functions, given some of the failures that we've seen in traditional rails?
So that's a good question. So I think I'm going to back up a second as I answer it. So one of the big shifts in 2020 was when Paul Tudor Jones came out and said, this is my thesis for inflation. It wasn't a Bitcoin thesis, it was an inflation thesis. And he had 4 ways to play it, of which Bitcoin was one of them. And that was a big deal because it was the first time somebody came out and said, we actually are making a real bet on Bitcoin here as an inflation hedge, and someone from the traditional world that historically would not have been viewed as someone in crypto. And that was a big deal. And I think because of what's happened with the banking crisis right now, I think in the next 3 to 6 months, you're going to see a lot of announcements, not necessarily from funds, but maybe even from like corporations who were like worried about making payroll and all of a sudden, had to spend a weekend in the war room trying to figure out, like, what am I going to do if I can't make payroll? Like, there has to be a better solution. And it doesn't necessarily mean that they're going to put Bitcoin or ETH on their balance sheet, but it certainly means that the individuals behind those companies were starting to think about there has to be a better alternative than waking up on Monday not knowing if my money's in the bank and whether I can make payroll. So I think we're about to see some really big announcements from non-traditional crypto players, whether that's companies or endowments or universities or funds, over the next 3 to 6 months, talking about why they are moving into digital assets. With that said, I think the DeFi is probably the next in line from that, because the problem with DeFi is people aren't really testing it; they're not using it, right? DeFi itself is actually not that challenging to use, right? There's a lot of things in crypto right now that have bad UI and UX. That are hard and challenging to use. Most of the DeFi applications are actually pretty easy, as long as you're comfortable with a MetaMask or other a self-hosted wallet. Actually, physically using an Aave or a Compound or a Maker or a Uniswap or a Sushi or your DYDX, you name it, is actually really fairly easy. I think that's probably the next step, because again, once you start to question all the things you used to do, and there's no question, I mean, go back 2 weekends ago, I've talked to many small business owners, I talked to many high net worth individuals, many funds. They were freaked out. They were like, I don't know if I can make payroll, or what am I supposed to do with my money right now? That stuff eventually leads to looking at solutions. And I think once some of these individuals start testing it personally, and then they start bringing it to their companies and realize, actually, this is not the volatility of crypto. This is really just a better way to transact and to get some loans and to move assets around from a working capital standpoint. I think we're probably not too far away from a major announcement of a company using DeFi as well. And you've seen little snippets of it, right? I mean, you've seen, I think it was BNP maybe, or who had dabbled a little bit in some DeFi. Obviously, there's some real world asset buzz right now talking about Maker and some other platforms, but I say maybe 6 to 12 months from now, you'll see a major announcement of an institution that said, this is actually a better form of banking, and it was easier and it was cheaper, and it will set off that kind of next wave of usage.
Do you think it'll be a European bank or a US bank?
I'm not sure it'll be a bank at all, but I definitely don't think it'll be a U.S. bank. I think if it would be a bank at all, I think it would be European or even potentially African or South American. I don't know if it would really be a bank. It might be a fund. It might be a small business. Some of the small. I mean, we forget how much of the economy is driven by small businesses, and small businesses were legitimately freaked out about what happened 2 weeks ago. I mean, these are people who, you build a small business, maybe you're in the food industry or hospitality or tech or whatever. It doesn't necessarily mean that you're savvy in finance. And to wake up one day and have your CFO or whoever, maybe you don't even have a CFO because you're a small business, and say, we don't know if we can make payroll, or we don't actually know if our cash is there. That's a scary thing. And you start to think about how else that you can get working capital. And if DeFi is one of, a short list of other solutions, you will see some of these companies and individuals start to dabble in that. And I think, again, I just don't think the genie can go back in the bottle when you have a situation like we had 3 weeks ago. Even though to the credit of U.S. regulators, the Fed, the FDIC, the Treasury, the speed with which they solved the problem temporarily was commendable, and it was good. But that weekend was stressful, and that changes people's opinions. It changes people's workflows, and every single small business and fund right now is thinking through solutions. And again, it doesn't have to be even a handful of those businesses move towards DeFi as a potential solution. That's a pretty big confidence boost, especially when you said DeFi just continues to pass stress test after stress test after stress test.
And especially given the shift in the trust framework that you mentioned earlier. And I'm going to take a step back as well. What you've mentioned is very much the boots on the ground, the practical approach, but there's also the theoretical approach we've seen over the past few years, since 2020, if not even before. Economic theory, orthodox economic theory, just being thrown out the window. And arguably, we're probably coming up for some more orthodox theories just being thrown out the window. And when there's a vacuum of orthodox theory, but that opens people's minds to new theories, to new possibilities. This hasn't worked. Fine, let's try something else. I mean, for one, it's not that long ago, we were suddenly all MMTers, right? And obviously that didn't work, brought us partly to where we are today. But there's a shift in the sort of air, I think I can say, of economics is changing, philosophy is changing, and stepping even further back, going into the global stage. I read with concern about countries such as Bolivia that are running on dollar-based fumes. They don't have enough dollars to pay for simple things like importing, powdered milk kind of stuff for babies. And what if the central banks of these countries that do struggle with access to dollars, what if there was an asset that they could hold on their reserves that could be converted into dollars 24/7, 365, and that was not subject to the monetary politics of a third party? What if? So I wouldn't be surprised to see at some stage, rather than before the end of this year, if not even sooner, some central banks start to dabble with the digital gold. We know that gold purchases by central banks has been shooting up over the past few months, but gold is hard to store, it is hard to verify, it is hard to move when you really need to, and you certainly can't do so on a Sunday night when you can't pay for the oil shipments that your country needs to get to work in the very next morning. So that is also something that would distort the market. So I'm not saying it's necessarily a good thing, but it's a sign of how perspectives are shifting.
For sure. Well, listen, Noelle, I think we have to stop here on time, but we're definitely going to have you back on again. This was great, and I love hearing your perspective on things. Noelle, where can people find you and reach you if they want to get more from you?
Thanks very much, Jeff. Really appreciate it. I encourage everyone to sign up for the Cryptos Macro Now newsletter on Substack, and you can follow me on Twitter at Noelle in Madrid.
Wonderful. And as always, you can get our blog on our website, ar.ca/blog. That's our 2 Satoshis for this week. Noelle, thanks again for joining us, and we'll have you back again soon. And that's it for this week, folks. We'll see you again next week. Thanks for joining.
Thanks, Jeff. Bye, everyone.